Let's talk right now about where investors can find opportunities in the markets after yesterday's confusing and wild ride on Wall Street. Joining us for that is Julian Emanuel, the chief equity and derivative strategist at BTIG, and Simeon Hyman, who's the head of investment strategy at ProShares. First of all, does either of you have any idea what happened yesterday? It was just a weird sell-off. Nobody could really point to it. It wasn't a massive one, but it did leave people kind of scratching their heads wondering what happened.
We're going to keep having it as long as we're in an uncertain period with regards to the virus.
So that's what you think it was, just uncertainty.
That's the near-term volatility.
Well, that's a little frightening.
South Korea popped up as having more bad stuff.
Right.
You agree with that, Julian?
Well, we actually saw a little bit of program selling coming out of Europe. The DAX, which has been on an incredibly strong run in an economy where there are political issues that grew by 0.0% in the last quarter, and yet you're at all-time highs. Things started coming off there. I think we have to put this into perspective. The VIX has been trading 14, 15, 16, lower than the long-term average, and we've had a lot, a month and a half, 6 months, a year's worth of very strong gains. It's normal when you get this overbought to start to see a little bit more volatility.
I totally agree. I think it's weird that we've held in to this level, but maybe that's investors trying to see through this. Is there a point where they say, okay, this is scarier than we thought, it's lasting longer than we thought?
I mean, history is sort of unambiguous on this. 6 to 12 months after pandemic, the market's almost always been up. In the near term, you don't know what's going to happen. The thing that's worked since the beginning of the year, zero coupon bonds are up 13%. If you want a very reliable hedge in this environment, if the virus gets worse, the treasuries are going to continue to rally and take a 25 or 30 duration. But it's going to flip the other way quickly when it clears up.
So are you advising that, or are you saying
as a hedge? I mean, you don't put all your money in that, but look at other hedges. It's been very unreliable. So if you look at the franc and the yen not doing what you would expect, so other hedges are not necessarily as reliable. So in the short run, if you want to put 5 or 10% of your portfolio in zeros as protection, but remember, they will flip quickly. In the back half of 2016, after that bottoming of yields, you lost it all. It will go back the other way.
Joe brings up a good point. We were talking in the last block about it. Just if there are pockets that show up here, as many experts have said is very likely, that it would be difficult to try and find safe havens outside of a zero coupon bond or something like that. You look across the stock market, and there wouldn't be too many places that would be immune.
No. So when you get to a situation like this where there are a lot more known unknowns, our advice tends to be, look, if you're an investor, and again, going back to the run that we've had over the last year, been very, very large, is that you want to think about it, and this has happened so many times over the course of this 11-year bull market, is you need to envision yourself being a buyer of stocks down 10 to 15%, okay? Because these things happen every 9 months, every 12 months or so.
Would you wait to 10 to 15%, or if you see a pullback of 5%, would you say, okay, this looks a little better price to me?
I think we need to see the evolution of the news, quite frankly. What we would say is it depends on the timing. If it's very sudden, as in the next several weeks, we might be a little bit more patient, because particularly with regard to the coronavirus, the closer you get to spring, the medical evidence is the higher the probability is that the problem starts to dissipate, but we're still in February.